Good afternoon, good evening. My name is Valentyn Khokhlov. I'm a CFA charter holder, and this is my investment club. And today we'll talk about smart betas and semi-active portfolio management. This idea, surprisingly, I've heard about smart betas in 2015 or early 2016 when I was studying in London Business School. It was quite a popular idea, but at the time, which is a bit surprising for me because long before that, about 2010-2011, when I thought about starting my own wealth management practice. I developed some models for portfolio management, and also I studied ETF market, as I supposed ETFs to be the main vehicle to get exposure to some asset classes for me, for my individual investment management firm. And then in 5 years it materialized in such idea as smart beta, which seemed quite trivial to me by that time, and I think there's much more in that idea, much more like a buzzword than essence. But let's see what is it about. So, a small recap about portfolio management strategies. We talked about that before, but we need that for our today's session as well. So we have passive management strategies, which are basically following the market, and it's a buy and hold strategy, which does not depend basically on managers' abilities. So you don't rely on a manager to develop strategy. You just put your money into index fund or ETF following market index, and that's it. It's very low cost strategy. You basically pay a brokerage fee to buy shares of an ETF. That's it. And on the other side of the spectrum is active management, which is how this industry started basically, when you have investment professionals who decide on everything, who decide on asset allocation, sector weighting, style allocation, stock picking, market timing, and basically the results, they strongly depend on the manager's abilities, and it requires high investment management fees, basically, because the manager, in general, it's not a person in general case. You have analysts, economists, portfolio managers, risk managers, compliance, legal persons, accountants, and so on. So you have an investment management firm to basically create active management strategy, and you need to compensate for that, and it costs quite significant amount. And the idea was to have a compromise as semi-active management, which strives to adhere to some rules instead of relying purely on managers' abilities. So depend less on abilities, depend more on rules, which are objective and transparent, and you know how they work basically. Less objective decision making, and it was supposed to reduce costs basically as well, reduce risk and reduce costs. So what we can do for that? There are several approaches basically to semi-active strategies. Historically, first, as I perceived it, because it started in 70s, late 70s, early 80s, probably with the trainer black model, for example, which was included in the CFA curriculum when I studied. Maybe now it's not included, and it's quite an old model, and I don't think it's practically used nowadays. But the idea, I like the idea. I will not speak about the trainer black model itself, but the idea is quite simple. You split your portfolio into two parts. Passively managed core, which is the largest part of your portfolio, and actively management satellite, which is a small part, but you use the satellite in order to add value with active management. And in 2013, when I consulted one startup hedge fund in Dubai, I suggested this core satellite approach for them, for Islamic finance, because Islamic finance has some constraints. It's an interesting case. I think we need to speak separately about Islamic finance and how this core satellite approach works, or was supposed to work for this Islamic finance fund. But still, it's a rare occasion when I think it makes sense. In general, this core satellite approach, I think, doesn't make much sense for like standard investor. So smart beta was an approach quite simple basically, but much more general, so which should work for generic public. So basically it starts with following the market and starting deviating from the market on some factors such as sector or style or whatever, but small deviation, one or two factors, not very much different from the market, so pretty similar in terms of risk and return, but adding extra return if you deviate in a favorable direction. And the direction in which you deviate based on factors, and you use sensitivities to those factors which are factor betas. So you use those individual factor betas to judge on how to deviate and how much to deviate from the market. Another possibility, which I don't believe to be a real strategy, is to create a ETF portfolio, so fund of funds basically, because each ETF is fund and you create your own fund consisting of other funds. So I don't think it's a viable strategy. I think it's a technique, a good technique if you need exposure to some asset class you can't enter directly, or it's costly to enter directly, so you use ETFs as a low-cost alternative to get exposure to some asset class. For example, physical gold or some equity in frontier market, or maybe bonds, some low liquid bonds or real estate, something like that. It might make sense to get exposure using ETF. But it's a technique. I don't consider creating a portfolio of ETFs just for the sake of creating investment strategy. So I don't think it can be called semi-active strategy if you just buy 5 equity ETFs. It can be technical implementation, but not a strategy. And finally, some people argue there is such a strategy as alternative weighting. So you use, for example, equal weights for assets, and therefore you create a different portfolio structure. And that may be a viable investment strategy, basically, but you need to prove it makes sense. And we will talk about it today as well. So let's start with just simple notion of beta. Or first we'll see how it works, how it looks like on the graphs, and scatter plot, and here you see on x-axis daily returns on S&P 500 proxy, which is SPY ETF. ETF tracking this, physically tracking this index, and on the y-axis you see the daily returns on my S&P 500 tracking portfolio consisting of 15 assets. So just 15 assets tracking this index. And what you see here, you see the equation of this line. It's a least squares line for this scatter plot, and this coefficient you see before x. It's basically it's beta. So this slope coefficient is beta. Here it's 0.9787, which is close to 1, and the market portfolio has a slope of 1 and the beta coefficient of 1. And R squared is almost 0.80, which is not very good, not very bad, but you see 15 assets to track 500 assets, you can't just have an ideal match. So let's see how that works on individual assets. So it's Apple. Again, the horizon is 10 years from 2010 to 2020. In this case, you see this plot is more scattered, and basically this beta coefficient is 1.0763. And R squared is much less, so it's much more dispersed, and the beta is higher than 1, so it's Apple stocks are more volatile, so it, when market changes, Apple on average change more than market. And here we have opposite, we have Procter & Gamble, which is consumer staples, which has a stable demand, and even from this plot you see visually it's less volatile. So market is more volatile than Procter & Gamble, and we see on this equation as well. So the beta is 0.5933, which is well below 1. So it's low beta stock. And another stock from oil and gas industry, ExxonMobil, the beta is close to 1, it's almost 1. It doesn't mean that ExxonMobil is a proxy to the market, because if the sensitivity is 1, it doesn't mean that the stock always has like the market. But the sensitivity is the same, so more or less ExxonMobil is as volatile as the market itself. So different assets, different betas, you see how it looks like. Now let's see what the theory says about market beta. So it's a sensitivity of assets return to the market return, as I have already said, and you see this equation, you see this is market return, and coefficient before this is beta, and the part of the return which does not depend on the market is alpha, and this is the error term, and this is the asset return time t. So basically it's linear regression, because you have one, it's linear and you have one independent variable. You can solve that using the least squares and have the following formula for beta, which is covariance between the asset return and the market return divided by the square standard deviation of the asset return. Basically quite simple. Then we have a very famous CAP model, which is capital asset pricing model. You probably know about that much already. So the expected return on the asset, according to this model, according to its assumptions, because there are several quite strict assumptions, but under those assumptions, this expected return equals to risk-free rate plus beta for this particular asset multiplied by the risk premium, which is expected return on the market less the risk-free rate. So you see here the only one input which is unique for the asset is beta. All other inputs they are like common for all assets. So the beta is the only one input which determines the expected return on the asset. And that's why from 70s it was regarded as a systematic risk and the only component of risk for which the investors got compensated, because the non-systematic risk or diversifiable risk, so you can diversify it away by using a portfolio of a certain size, so 20 to 30 assets are considered enough to diversify away most part of non-systematic risk. So you only have systematic risk, and for systematic risk you only have this beta coefficient, which is enough. Well, we have much criticism of CAPM, and per se this model does not work in portfolio management, at least now. It's used very often for getting estimates for the cost of equity capital. It's another topic. There it is used, but in portfolio management, unfortunately, no. Despite the fact this model is quite appealing because the betas have very interesting property, mathematical property called additivity. So the beta of the portfolio is a weighted sum of asset betas. So you just multiply weight of first asset by its beta and add and so on, and add the last asset weight multiplied by its beta. So you just have a weighted sum of betas and it's the beta of the portfolio, which is very good. It's very convenient. Other risk measures, they don't have this property, and they are much more complicated to calculate. But still CAPM doesn't work very well for predicting assets returns, so we have some generalizations. They are mostly based on relaxing assumptions of the CAPM, and instead of using one risk factor, which is market return, they use several factors. For example, this model, just generalization of this linear regression into k input variables, not just one but k, and therefore it has not just one beta but several, specifically k betas, beta 1, beta 2 and so on, beta k. And the corresponding model called APT or arbitrage pricing theory model, and it's pretty much similar to CAPM, but it has k risk factors, k risk premiums, which is denoted as P1 to Pk. Each risk premium is the expected return on this factor minus risk-free rate, basically the same. So, and each risk factor has its own sensitivity or beta coefficient. So that's it. What are those factors? I took some insights from, for example, BlackRock site. They list such factors as macroeconomic, microeconomic, macro are inflation, GDP growth rate, interest rates, and micro factors specific to individual asset, which is volatility, liquidity, size, style, momentum. And those of you who are familiar with Fama French 3-factor models or 4-factor models, you immediately recognize those factors, the last ones, last 2 or 3 ones, because if we take classic fun of range three-factor model. The first factor is the same as in CAPM, it's market. Second factor is size, and small companies should deliver higher return than large companies. So small minus big is a risk premium for small size. And then style, high minus low, high price to book ratio minus low price to book ratio, and price to book ratio related to growth or value style, because if company is high growth, it implies its price to book value of assets is high, and otherwise for value stocks price to book ratio tends to be low. So high minus low is risk premium for growth stocks. And the fourth factor, which is relevant to four-factor model, is momentum, MOM or UMD, up minus down, assets that has just risen in their price, so went up, minus assets that went down, and like recent winners tend to have risk premium attached to them. So that's a momentum factor. And that's not the only choice. You have to choose other sensitivities. For example, you, instead of getting beta to entire market, you can have betas to a particular sector. So sensitivity of assets return to the particular sector's return, and for sector you can get index, S&P 500 sector index or sub-indexes, and relevant ETFs. So basically you can calculate easily sensitivities to those as well. Okay, so the theory is over. Now, how to implement it? So you need to realize first that the choice of factors is on you. Nobody can decide. It's input to any model. So you decide, you as an investor or you as a manager, portfolio manager, you decide which factor to choose and which exposures to each factor to choose as well. Which factors to overweight and which factors to underweight and so on. So it's on you. And now, when those decisions are taken, how to construct a portfolio? So basically there are one mainstream way, which I list here as the first possible implementation. So you start with a broad index, for example S&P 500, and you adjust weights of individual sectors. Basically, you choose one sector to overweight and another sector to underweight. So just get those assets or this sector as combined, and you increase weightings of those particular assets, and you decrease the weights of another sector which you decided to underweight. So basically it sounds quite simple. How to do it in practice? If you have stocks, so the technique called stratification, or using a stratified sample. Because if you have S&P 500, I can't believe you will work with 500 individual stocks, realistically. You'll probably work with around 50. 40 to 60 I think is a feasible size of a large portfolio. So you divide all the stocks within this index into 11 sectors, for example, and into two styles, value and growth. And you also can use a third dimension as size, small cap, mid cap, large cap. For S&P 500 it does not make sense because it contains only large cap stocks. So you only use two dimensions, but you can use 1, 2, 3 dimensions, and if you use 3 dimensions here, it's important to see that you have 11 multiplied by 2 multiplied by 3, which makes 66 individual cells. You need to populate those cells, which is quite a number actually. 66 is not that small. Stratification is a common technique used to construct bond portfolios, where you have less possible choices. Also, I will give 3 dimensions here. First is duration, which can be short duration, middle duration, long duration, like 3 choices. Type, like government, municipal, corporate, which are again 3 choices. And, for example, rating or rating group like A, B, or investment grade, lower grade, junk bonds. So you have 2 or 3 groups here. So you have, let's say, 9, 3, 3 and 3. So you have 9 possible cells for bonds, and you need to populate those cells with 2 values. First value is weight. So you assign weight to each cell, and if you want to overweight some sector or some duration or some rating for bonds, you just increase the weight for this cell and you decrease weights for some other cells. So you assign weights, and that creates your unique strategy. And then you need to choose representative assets in each cell, which is kind of stock picking, of course, but you are restricted to particular choices, because for stocks you need to choose within particular sector, style and size. For bonds you need to choose within particular duration, type and rating. So just your choice of this representative asset, 1 or 2 assets per this cell. So you construct this portfolio using this stratified sample of assets, and that's it. But if you have access to ETFs that match your desired factors, you can use it. You can basically get exposure to a diversified portfolio at low cost, and instead of choosing representative assets, use ETFs that fit this particular cell or even several cells. Well, if you can assign a weight. So it works easier for stock portfolios. So for example, you want to overweight pharma stocks and high-tech stocks, and underweight oil and gas stocks, and maybe some other. So what you choose, instead of putting all your money into one S&P 500 fund, you buy 11 sector funds, but you increase your holdings of pharma and high-tech funds, and you decrease your holding of oil and gas fund, comparing to the weights you would have if you use the index. That's one option. Second option is to simply buy this single fund, especially if you have a long-term strategy. You can get your normal exposure to, let's say, SPY or other ETF that replicates S&P 500, and if you need to overweight some sector and underweight another sector, you just open a long position using sector ETF for the first fund, and you open a short position of the exactly same size, I mean dollar size, for the second ETF. So you have it's a kind of core satellite approach basically. So you have your core invested into S&P 500, and you have your satellite consisting of long and short positions that give you a temporary exposure to those high-tech and pharma sectors on the long side and oil and gas sector on the short side. So basically, how you can use ETFs to create a semi-active portfolio strategy in this simple case. The second and third approaches, they rely on mathematical optimization, and few people would use it, frankly speaking, because it's kind of complicated. It sounds complicated. It's not that hard to implement, basically, because even in Microsoft Excel you can do everything here using the Solver plugin, or if you don't have access to Microsoft Excel with Solver plugin, you can probably find a free mathematical package that has mathematical optimization functions. It's not that rare. So basically the optimization model A, so the first model we consider, the core part here is the constraint section. So the first constraint here is that you have the betas, each beta, factor beta, set to be equal to some target level. So you have those target exposures for each factor, and you here is a beta with asterisk, and you have this portfolio beta on this factor as the weighted sum of asset betas. As you remember, additivity feature gives us this easy way to calculate every beta, every factor beta for the portfolio, just weighted sums of asset betas, and you set it equal to your target level. Then this next constraint, that the sum of the weights of all assets equal to 1, and optionally you can have this constraint on individual asset weights to be within some boundaries. And those are constraints. Now we need to choose objective function, which is basically not very essential. You can do without it, basically, but here in this case we maximize the expected return on the portfolio, which is a common objective function in portfolio management. So what we would achieve with this model? We will have a portfolio which maximizes the expected returns using the selected set of assets and has all factor exposures equal to our desired factor betas. You can solve this model using simplex method. It's very easy mathematical programming method. But you need for this model, you need to have as inputs expected returns on assets, which may be a problem because you don't know expected returns. You need to estimate those, and those estimates are not easy and kind of tricky point in portfolio management. And this model may not work if there are no combinations of selected assets that leads to this target level of factor beta. So if there is no combination, no way that your selected assets combined can have the exposure of this particular level, this model will fail. There's no way it will develop some solutions if there is no way to achieve this exposure on each factor beta. We can use another model which will work even if there is no combination of assets that leads to desired factor exposure. This model does not guarantee that you achieve all the desired factors exposure, but what it guarantees? It guarantees that the squared deviations from your desired factor exposures will be minimal. So this model minimizes the squared sums of deviations from factor betas on all your factors. So basically you see here in this sub-expression you have portfolio betas on factor j and minus desired beta on factor j, so you have this deviation, you put square of this deviation and you sum all those square deviations and then you minimize it. So this model is guaranteed to deliver you some solutions, and this solution will be absolutely the best one in terms of the deviations from your desirable factor exposures. But this model has nothing to do to the expected return, so it does not guarantee you will get a portfolio with the highest expected return, highest possible expected return. Also, this model is quadratic, so it requires quadratic optimization. It can be solved using gradient method, not that complicated as well, and most packages they can do that. It's not much problem. Technically it's more complicated than simplex method, but it's not a big deal. On the other hand, you don't need to predict expected returns, which is advantage basically. It's not only a drawback, it's also advantage because you don't need to get that tricky input which is hard to estimate. Now, third possible way to perform this portfolio optimization and get a portfolio with desirable factor exposures, but starting with entirely different methodology. Instead of looking at individual factors, it's more generic approach, by the way, because it starts, it's developed for tracking portfolios, for getting a combination of assets that track some kind of a benchmark in the best possible way using those assets. So basically you start with a custom benchmark. If you have external benchmark you need to track, it's straightforward, but in our way we have some desirable factor exposures. So you basically use those factor exposures, those betas, to construct an artificial, non-existent asset, a model asset that you use as a benchmark. Of course you can only do that for some kind of historical sample. So it's always backwards looking. That's a drawback of this implementation approach. But otherwise it has some advantages. So you basically can construct any custom benchmark. And then you can create a combination of assets that tracks this custom benchmark in the best possible way. How to do that? So I will give you the final result. How to get to this formula? You can read my papers in the internet. You can find my papers on tracking portfolio optimization, which shows that in order to minimize the tracking error volatility, or TEV, you need to minimize this objective function. So I have this proof for this objective function, how to get here from TEV. And this objective function is quite simple. So it's a standard deviation of the portfolio squared. So you have weights on assets multiplied by the covariance of those assets, and you sum it on all those assets you have in your portfolio. And less, this is the squared standard deviation of a benchmark, of this custom benchmark you have just created. And then this beta, you see the weight of asset and beta of asset, but beta not against the market, but this beta is the sensitivity to this custom benchmarks. So you measure this beta for each asset against this custom benchmark. Again, if you have constructed this custom benchmark using several risk factors, and each risk factor has its own risk beta. You already have all those factor betas integrated into this custom benchmark, and then after that you calculate asset betas with regard to this custom benchmark. So this two-step way to account for sensitivity between assets returns and factor returns, not indirectly as we did before, but through a custom benchmark as an intermediary asset. So here is a model that minimizes the tracking error volatility. So objective function constraints very simple, only that all the weights sum up to 1 and boundaries on each asset, lower and upper boundary on its weights. And you use quadratic optimization as well, and you get the optimal solution that minimizes the tracking error volatility again on the historical data sample. So it's how to do it, how to get such a portfolio. What are the pros and cons of this semi-active portfolio management? So first one is that you use rules instead of judgment. So you don't make any market timing decisions, or you don't make, or almost don't make, any stock picking decisions. The only way you use stock picking is when you have stratified sample. So you create several or many cells, and you assign weights to every cell, and then you need to populate each cell with some assets. And in that case you use some stock picking, because you choose which assets are representative assets for those cells. So basically there is some room for stock picking, but very limited basically. Still, you need to make quite significant amount of decisions. So you need to decide on which risk factors you choose, or on which benchmarks you choose, or how to create this custom benchmark. So there is still space for kind of important decisions. So you can't avoid this subjectivity, you can't avoid this judgment. Second advantage, you don't need to have expected returns. Only in one model that we have considered today there were expected returns as inputs. And you know, as I already mentioned, the need to get expected returns as inputs is the weakest point of mean variance optimization, which is mainstream portfolio management technique started with Harry Markowitz's portfolio theory. And the weakest point of it is the need to evaluate the expected returns for all assets in the portfolio, and it's the point, the least robust point of the theory. And if you don't need to calculate the expected returns, it's very good basically. But instead of evaluating the expected returns, in those factor models you need to evaluate sensitivity to the factors. So you need to evaluate those betas. And well, you have those formulas, you can run the regression and get the betas from those regressions, but nobody can guarantee you that the betas you evaluate using the historical data samples will continue to be the sensitivities in future. The same as with expected returns. You can calculate the mean return on historical sample, but nobody can guarantee it will be the expected return for the future. The same is with the betas. Nobody can guarantee that the beta you get from regression will continue to reflect the sensitivity of the asset to the risk factor in future. So no much help here. Well, it's better because no need for expected returns, but still you have another value to estimate. Does it reduce costs? It's a question, because, well, microanalysis remains. You need to select factors, you need to assess the sensitivities to those factors, so you need some analysts. You need someone to do the job with stratification or with the optimization, so you just cannot get rid of portfolio managers and some quants probably. So it may reduce costs a bit, but I would not say it reduces them dramatically. And does it lower risks? Well, maybe, because for purely active portfolio management you can have high risks, but basically most of those relate to the fact you may have a concentrated portfolio, and if you have a diversified portfolio, so you diversify away those non-systematic risks, not only on one factor but on all factors. So you diversify away risks. If you have a sizable portfolio with many assets, you basically lower those risks anyway. So I don't think there's much space unless for active management you have a concentrated portfolio. So you see, this semi-active portfolio management, well, I'm not that optimistic that it solves all the problems and gets you a low cost, low risk solution that delivers extra value related to purely passive management. Finally, let's consider the question of weighting. Does equal weighted portfolio have a better, have more sense than market weighted portfolio? Let's consider S&P 500 equal weighted total return index from this index provider and compare it to S&P 500 total return index, standard index, which is market cap weighted. So 1 year up to today, you see this white line is equal weighted index and blue line is the market cap weighted index. White line is higher, so 1 year equal weighted portfolio is better. 3 years horizon, blue line is higher, so market cap weighted is slightly better, about 2% per year better than equal weighted. Horizon of 5 years, the picture is the same, so blue line is above, which means equal weighted portfolio is worse than market cap weighted portfolio. Again, about 2% per year is the difference on average. Time horizon 10 years, the longest time horizon we have. The equal weighted portfolio is slightly worse. The difference is not significant, less than 1% per year, but still you see that market cap S&P 500 delivers better results than equal weighted S&P 500. Of course, it's just one particular case. Doesn't make it works for all portfolios, but here we see on this case that equal weighting in this particular case did not deliver superior or better returns. So you can't say that equal weighting is better. It may be better for some cases, for some investment horizons and some portfolios, and it may not be better for others. So you can't say it's better. Well, it's easy to build a portfolio using equal weighting because, for example, you have 20 assets in your portfolio. You just assign 5% weight to each of them. You have 50 assets, you assign 2%. You can calculate easily in your mind. But if you use some software, it doesn't matter. The computer can calculate market-weighted portfolio in fraction of seconds. So basically, if you have the data, market cap data, it's very easy to calculate weights. For a computer, it doesn't matter if it's equal weighting or market cap weighting. So not much difference here unless you do everything manually. But in case of rebalancing, equal weighted portfolios require much more in terms of rebalancing because they deviate each period much more. Basically, if you have a pure market cap index and market cap weighted portfolio, it requires no rebalancing at all. It's auto rebalancing. Of course, in practice, you don't have 500 assets in your portfolio, so you still need to rebalance. But with market cap weighting, you need to rebalance less than with equal weighting. Why is so? Because, market cap weighted portfolios, they overweight those assets that has just grown, has just increased in their price and therefore in their market capitalization. So they increase both in your portfolio and in market capitalization. But with equal weights, if those assets has just grown, their weights has increased and the deviation from the target weighting is more. But those assets that has just fallen in price, their weight has decreased. So you need to buy those assets that has just fallen and sell those assets that has just increased in price. And that is absolutely what the contrarian strategy means. So if you are a proponent of contrarian strategy, then you favor equal weighting. And if you don't believe in contrarian strategy, then you should not favor equal weighting. And in our previous investment club, I provided you a long discussion of contrarian strategies, not my research. It was a book which I helped to translate and I reviewed. It's a part of this book written by Antti Ilmanen, quite famous guy in investments, and he analyzed contrarian strategies, and one of the conclusions he had that basically if we consider just two kinds of strategies, contrarian and momentum, then momentum strategies, frankly speaking, perform better. They are not popular because in theory contrarian should work, but in practice momentum works better than contrarian. And the reason is, in contrarian strategies, you see the price has fallen and you consider it always as a temporary deviation from the intrinsic price, intrinsic value, and you expect the price will rise again. So you tend to buy assets that have just declined in price and sell the assets that have just increased in price. But this may not be a temporary deviation. It may signify that there was a correction and it has just ended and the price has just returned to its normal level. So there's no need to buy this asset, it's not cheap. Or more than that, it may signify that there is a new normal level on this asset because a company, for example, uses a bad business model and it loses its market share, so its prices goes down, so it gets cheaper and cheaper, and it will get even cheaper unless there are significant changes inside the company. So basically, if you believe in contrarian strategy and this price change is not a temporary deviation, then you start losing money. So basically, you can't tell in advance which is the case. Is it a temporary deviation, or it's a new normal level, or there will be a price momentum? So basically, as practice shows, contrarian strategies may work in some moments, may not work in other moments. So unfortunately, you cannot rely on them, and therefore equal weighting, which theoretically is justified under contrarian strategy, it may not work in general case. So that's basically it. We have considered everything I planned for today, and I would like to thank you for your attention. And I plan to return to more active streaming on investment topics this fall, and maybe consider some more complicated topics which require more specialized attention in risk management and so on. So stay tuned.